Welcome to our second session on asset liability management, or ALM for short. When we stopped earlier, we had a list of definitions to walk through. The most important, or the first, is sigma or standard deviation. This is something that we're all comfortable with given our introduction to statistics. Sigma, standard deviation, vol, or volatility are all terms that refer to the range of variations that we're likely to see. In our specific case, with respect to ALM, whenever we speak about standard deviation or volatility or vol within the context of this course, we would be referring to the likelihood or the ranges of value that we are going to see with respect to changes in interest rates. So interest rates may go up or interest rates may come down. And when we speak about volatility of interest rates, our primary interest or motivator is to determine the ranges that we're likely to see. So for example, if rates are at 10% and the standard deviation or volatility of rates is 1.5% expected over the next 1 year, you're going to see 15 basis points or 0.15% movement plus minus over um, over the next 12 months. So if rates are at 10% right now and the number is 1.5%, the range of rates that you're likely to see is going to be from 10.15% to 9.85%. If the same number jumps, if the same volatility jumps to 15%, this range will shift from 0.15% to uh, to 1.5% to 1.5%. So for example, if rates are again at 10% and volatility is 15%, the range that you will see is going to be plus minus 1.5%, which means that you will see movements as high as 11.5% and as low as 8.5%. After standard deviation comes the concept of duration, which is covered separately in our session on duration and convexity. But for the purpose of completeness, for us, duration represents or refers to interest rate sensitivity. So how would prices change when interest rates go up and down? Sigma, as we defined earlier, was how likely are interest rates. Um, what is the likely range of values that we are going to see over the next 12 months with respect to interest rates? Duration is when these rates change, what is going to be the impact on bond prices? So again, let's say if I have a 10-year bond and the duration of that 10-year bond is 8%, the interest rate sensitivity of that bond is 8%. If rates go up by 1%, value of the bond is going to come down. So if rates go up by 1%, the value of the bond with a duration of 8% is going to jump by plus minus 8%. If rates go up, the value of the bond will come down by 8%. If rates go down, the value of the bond will go up by 8%. Now, duration to a very large extent is a linear estimate, which means that if I were to draw a curve of bond prices where here we have two indexes and the vertical index refers to the change in the uh, price of the bond, and the horizontal axis refers to the change in the value or range of interest rates. So this is rates, this is price. If interest rates go up, bond prices come down. If interest rates come down, bond prices go up. So in this setting, if I want to estimate the interest rate sensitivity, the easiest estimate, the easiest possibility for me is to simply drop a tangent, right? And this tangent gives me an estimate with respect to what exactly is the slope of this curve. So So this linear line, this tangent that I've drawn, is duration. Convexity refers to the error estimate. Now this is the amount by which you're going to be off. This is the amount that you need to track. This is the amount that you need to add. It's the fix that will address the shortage or the problem or the issue created by duration's linear approximation. So convexity is it's a second order estimate. Convexity is the piece that will allow us to approximate the error and allow us to compensate for the error introduced by using duration as an estimate. The next topic is asset sensitivity. If you go back to the example of a bank has assets worth 100 billion and liabilities worth 90 billion and equity worth 10 billion. Now assume that all of these assets are in 5-year loans. So the portfolio is basically comprised of a 5-year loan that will mature at the end of 5 years, and the rate on this loan is fixed. So this rate will only get repriced or will only change at the end of 5 years. On the other hand, all the liabilities are raised and funded from a 1-year deposit, and the rate on this deposit will also be reset at the end of 1 year. So in this case, we have an asset which is a loan on which the rate will get reset at the end of 5 years. We have a liability which is a deposit on which the rate will get reset at the end of 1 year. In this specific case, it's the liability that gets reset earlier than the asset. So the liability will actually get repriced first before the asset gets repriced. You take the same example and you can actually switch it completely by adding one simple condition. By changing the rate, by changing the period at which the rate gets repriced or reset on the 5-year loan. So if this rate gets reset at the end of every 3 months, even though you have a 5-year loan, but the contractual rate on the loan gets reset in 3 months, which is faster and earlier than the rate that gets reset on the deposit. So the first scenario was 5-year loan, 5-year liability, 5-year reset, 1-year reset. The second scenario was 3-month reset, even though it's still a 5-year loan, but the rate gets reset at the end of 3 months, and the deposit still gets reset at the end of 1 year. So in the first scenario, because the liabilities are getting repriced first, are getting repriced earlier, are getting repriced faster than assets, we would say that the bank's portfolio or the bank's balance sheet is liability sensitive. In the second scenario, because assets are getting repriced first, we would say that the underlying balance sheet is asset sensitive. Now, the decision to be asset sensitive or liability sensitive is traditionally linked to your outlook on rates. If you expect rates to go up, you want your assets to get repriced faster, and you want your liabilities to get repriced slower. If you expect rates to rates going up, scenario 1. If you expect rates to come down, you want your liabilities to get repriced faster and your assets to get repriced slower, right? So depending on your outlook on rates, you as a bank, as an ALCO committee of a bank, as a financial institution, may decide that the appropriate sensitivity for your institution may be asset or liability sensitivity. Now, value at risk is again a topic that is covered separately in the section on value at risk that you can find within this course. However, for the sake of completeness, value at risk refers to the worst case shock, the worst case movement that you are likely to see. So earlier when we spoke about rates being at 10%, we spoke about volatility being 1.5% or 15%. We spoke about a range of plus minus 8. Now this is a range that is calculated at 1 standard deviation. But what if I calculate the same range at 2 or 3 standard deviation? What that basically does is allows me to replicate the normal distribution and determine the possibility of how or where rates would be at the extreme end of the distribution. Hence the term, hence the usage of the term value at risk for estimating not just the likely range, but also the probabilities associated with that range. So if you had all of these tools at your disposal and you use these tools to estimate the interest rate exposure for your financial institution, the next question is, what would you do with that information? How would you hit that risk? So there's a range of tools that we use in interest rate risk management, starting from interest rate swaps, uh, from caps, from floors, from IOs, POs, and a number of structured note, including range accruals. Right? All of these are instruments that can be used to hedge a given risk profile for a financial institution. Once again, these are topics that are covered separately in the course on derivative pricing and derivative products. So moving on, what we've done is we've done a quick review of some of the related definitions that we use in building an ALM model. Now let's talk about what is required in actually building an ALM model. The first piece obviously is the business model of the bank in question. And the business model of the bank in question starts off with the fact that the bank goes out and raises deposits and equity and then lends to creditors in the form of assets that are primarily um, loans and advances. Now, the fundamental step here is that as long as you can borrow at 8% and lend at 16% and make sure that your expenses are within the spread, make sure that your credit provisioning, your defaults are within the spread, you should make money. The question that banks ask themselves is that even though if I start at 8% and start at 8% for my cost of borrowing and 16% for my cost of assets, for the amount or the return that I earn on my assets, what are the risks? The first risk is that the rate on deposits may rise faster than the rate on liabilities. So that's risk number one. Interest rate movement is risk number one. The second risk is that um, while rates might move, the shape of the curve, the fact that my spread of 8% may reduce. The third is that I may actually have defaults on the portfolio, which may further reduce the interest rate spread that I'm earning, not because interest rates have moved, but simply because my portfolio has a higher rate of default than the expectation that I started my numbers with. The last and final risk is that it's possible that rates may not move. It's possible that my spread remain constant. It's possible that my defaults remain within certain range. But there is a small likelihood that I may not be able to roll over I may not be able to roll over the deposit in question. Which means that if you remember, we said 5-year asset, 1-year deposit, and the expectation was that every year, so every year we would be able to roll over, and on the 5th year when we roll over, the asset proceeds will pay off the deposits. But what if this does not happen? What if at any given point in time we're not able to roll over, or roll over at the same rate, or roll over at the expected rate, and actually have to roll over at a rate which is much higher than the rate that we're earning on the asset in question, the asset that we acquired or funded by the same deposit? So this last piece refers to or links to the liquidity profile or the liquidity mismatch. We've spoken about the interest rate mismatch or the maturity mismatch. This here is the question that deals with what happens if I don't or I'm not able to roll over. So if you want to estimate the impact of these four risk factors, the fact that interest rates may move, the fact that your spread may get reduced, the fact that you may have defaults, the fact that you may have a liquidity mismatch, of these four risks, the focus of ALM is on 1, 2, and 3. Credit basically comes in a separate area and will not be something that we look at in this session or in the session that follows. So if you want to estimate the impact of these three risks, you obviously need a financial model. You need a financial model that will allow you to reprice your balance sheet as interest rates change. You also need a liquidity model that will allow you to estimate the impact of rollover, the impact of the maturity mismatch that you have opted for as a bank when you introduce the concept of gap. The third piece that you need is you take this risk analysis, take the financial model, and take the liquidity model, and together calculate or estimate the impact on the required amount of capital you need for this bank to function. Beyond capital, beyond capital, what you're also interested in, what would be the impact on the required amount of capital if interest rates moved by more than expected. So you had a range of plus minus 8%. What if interest rates move by not plus minus 8%? Sorry, you had a range of plus minus 15% volatility. What if volatility is not 15% but 25 or 30%? You had a range of changes in bond prices of 8% plus minus 8%. What if that movement is not 8% but 12% or 15% or 20%? And from a liquidity point of view, your expectation was that deposits will roll over. What if deposits don't roll over? So if everything that went wrong can go wrong, what would be the incremental or marginal impact on the amount of capital that you need to put aside? If you extend this to the next step or summarize this, what you're essentially saying is that build a model that allows you to take in, record, and evaluate all the balance sheet related decisions that you've done. Then extend that to your profitability and calculate in P&L for the balance sheet model that you've just created. Then link it to a tool that allows you to reprice assets and liabilities. Combine all of this together in a list of reports that answer some very simple questions. At a higher level, they talk about what's your maturity mismatch and how is that quantified? What's your liquidity mismatch and how is that quantified? What's your repricing mismatch and how is that quantified? And if you were to take all three of these, what is the impact on two primary areas? The first is what we call shareholder value. The second is net interest income. So the first one tells me the impact on assets minus liability equals equity. The second one tells me that if rates go up by 1% on a going forward basis, is my net interest income going to go up or come down? So once you get these sets of ALM reports, 1, 2, 3, 4, and 5, 4 reports: maturity mismatch, liquidity mismatch, repricing mismatch, the impact on shareholder value, and the impact on net interest income. Once you have these 5 reports together, in terms of a dynamic ALM model, you can link 1, 2, 3, 4, all 4 of these elements to an interest rate generator. And this interest rate generator goes out and predicts, or simulates interest rates both in the short term. It generates a term structure of rates that give you an idea of whether rates are going to go up, whether rates are going to come down, whether rates are going to stay neutral, what is the outlook. And then you link this interest rate generator to a calculation engine. And what this calculation engine does is that it takes the new rate and runs a process where it reprices the balance sheet, recalculates the P&L, recalculates the assets and liabilities, and recalculates the impact of all of these on the ALM engine. Finally, once you have these six pieces together, you segment the reports out. Excuse me. You segment the reports out for presentation in front of the BOD, in front of the board risk committee, in terms of your ALCO group or your MANCOM, in terms of your treasury and risk function, and any other peer function who need to have access to this information. And the primary difference, as we mentioned earlier, was that as you move across the chain, the level of detail reduces and the focus on recommendation increases. So this completes a very short, very brief, and hopefully useful session on a number of core definitions and the approach that we use, as well as the 5 reports that we would be working with. In our next session, we will focus on looking at tools that help us answer these two primary questions. What is the impact on shareholder value, and what's the impact on net interest income on account of a change in interest rates, and how do I present and share these numbers with my senior team? Thank you very much for your time. This is Jawad Ahmed Fareed signing off for financetrainingcourse.com.